I'm Daniel Smith. I'm President and CEO of Cooperative Network. And it's my pleasure really to welcome our panel that brings decades of cooperative finance and credit policy experience to this discussion today. Joining us are Mark Udis, CPA, Principal, Agribusiness and Cooperatives with Clifton Larson Allen, Connor Sparks, Relationship Manager with CoBank, and Scott Shoup, Credit Manager with Inside FS Cooperative. Welcome, panelists, and thank you for taking time out of your busy schedules to join us today. Each of you has extensive experience in cooperative financial matters stemming from a wide range of experience and expertise. Our preliminary conversations leading up to today's webinar were really fascinating and insightful. Therefore, my role today is to allow you to share directly with our listeners best practices in developing, communicating, and enacting cooperative credit policy. So I thought we'd begin by going around and having each of you introduce yourselves, your experience, your roles within your organization, and then we'll open it up to a general discussion, maybe starting off with what is a credit policy and what should be in it and how it can be developed. And we'll just let the conversation grow organically from there. Questions, and we will take questions at the end, or you can put questions in the Q&A that we'll be monitoring as well. So let's start with those introductions. Scott, would you like to lead off?
Sure. Thank you for having me here today. My name is Scott Shoup. Like I said, I'm the credit manager with Inside FS. I've been with the company for about 5 years now, a little over 5 years. Prior to that, I've got some about 30 years worth of banking, various banking down in Illinois, both on the commercial and retail side of things, and happy to be here.
Mark?
Yeah, Mark Udis with CLA, Principal in our Agribusiness and Co-op Group. I've been a part of CLA, at least the Madison office here, for about 11 years, and have the opportunity to work with co-ops from pretty much coast to coast, pretty much from Virginia, Montana, Colorado, but obviously heavy presence here in the Midwest, based out of Middleton, Wisconsin. And yeah, I guess today I'm just hoping to bring some insights from what we see in our cooperative clients and I guess the good, bad, ugly, and everything in between.
Thank you, Mark. Connor?
Yeah, thanks, Dan. Connor Sparks here. I work at CoBank. I started in 2015. Currently, I'm a relationship manager that covers the grain and farm supply space in Wisconsin and Minnesota. My previous role was the same job, but in the Fargo market, which I covered North Dakota and South Dakota. So I've been with CoBank since 2015, first as an analyst and now as a relationship manager. Don't know if I'll be able to add as much value as Scott as Mark here, but happy to facilitate and explore these topics further with you all.
Well, thank you. Thank you, gentlemen. Scott, maybe I'll let you lead us off about your role there at Inside FS and how you built this credit policy, and we'll just kind of take it from there.
Sure. Well, yeah. So as far as my role, obviously in the credit realm here, and we have a team that handles all credit functions here within Inside FS. I'd say that probably our whole credit policy started coming around a little bit before I got on board, and then I've just kind of taken it and we've continued to run with it. But we've developed a credit policy over the past few years, and the whole point of the credit policy, I suppose, is to set some expectations, provide some accountability to both our sales team and our customer base. That it kind of really outlines what our expectations are, what we expect from the customer, what we expect from our salespeople, and that's been really helpful as we've pushed that out over the past number of years.
Mark?
I was just going to add, I guess, Scott, from your perspective, when you guys are developing that credit policy, I mean, what are some of the key things that, Insight FS considers as far as, underwriting standards? I mean, does that change whether it's a commercial account, farm member account, or whether it's, livestock or row crops, or I guess, how does that look like in Insight FS?
Yeah, so obviously we try to look at things as to your point, we try to look at individuals' situations. Obviously, a row crop is different from a livestock, but we have pretty specific guidelines as we look at um, you know operations. We look at we'll dig into some of uh, their financials. We will look at some of their other creditors. We'll try to do our due diligence on those and um, try to try to come up with um, an overview of the customer that gives us a good picture of what that risk profile looks like.
Sure. I'm gonna throw you a lob ball here, and I'm
Sure.
sure you'll hit it out of the park. But does Insight FS require a credit app to be completed before extending credit?
Absolutely, yes. We have both a commercial and a consumer credit application that we've developed and actually recently put it online last fall. It's been going very well. We do require specific information, required information that's on the application. Um, beyond the demographics, obviously. Um, for example, for an LLC, we do require personal guarantees on those LLCs, just because that many times those LLCs are new or there's not a whole lot of background information on those LLCs. So we like to have that personal guarantee in there to really take a good look at the overall picture.
That makes a lot of sense. I guess follow-up question on the personal guarantees for the LLCs. When you're getting those personal guarantees, I mean, how much effort and work do you personally or someone on your team goes through to actually validate that guarantee from that member owner, or that member, I should say, of that LLC actually has the financial means to guarantee, or that their guarantee means anything, I guess is what I'm trying to get at.
Sure, sure. You know, credit bureau tells us a lot, right? With that personal guarantee comes the ability for us to take a look at that customer's credit bureau. Um, if there is enough information on that credit bureau for us to make a decision, obviously we can go with it. If the credit bureau is thin, or if there's not a lot of information out there, or maybe there's some questionable stuff out there, we'll reach out and try to contact that customer and try to get a little bit more information out of them. A lot of times, some of these growers, they work with some smaller institutions or people that don't necessarily report to the credit bureau. So we've got to dig a little bit deeper and try to get that full picture there that we couldn't get maybe through the credit bureau.
Sure, that's helpful. I guess this might be one that either Scott, either you or Connor could probably address. But I mean, as far as red flags, I know you basically stated the credit bureau can show you a lot kind of behind the scenes, at least as far as the individuals go. But I mean, what are some of the red flags that either Insight FS or Connor, maybe even CoBank, that you guys look at when it comes to evaluating extending credit to customers?
Connor, you want to start off?
I think from the banker's perspective, we always defer to the customers, relationships with their clients in terms of determining, credit worthiness. I think the biggest piece we talk about with our customers is how consistent are you at applying your credit policy across the customer base. I think when we dialogue with CFOs and general managers, the feedback we get frequently is, there's a cohort of customers that have been doing business a certain way for a very long period of time. And, the application of that policy might not be, consistently applied with, that cohort of customers. And I think, that's one area that we talk a lot about, or at least have conversations with, is, is there a consistency across the customer base? And I would imagine, Mark and Scott, there's probably that conversation that happens, Mark, with your dialogue with leadership, and then Scott with your sales team. And curious on that, right? Do you guys have the discretion to, pick and choose, or do you guys go kind of across the board and apply the same standards with every customer that comes to you with credit?
I mean, we try to be as consistent as possible, just to, there's always a gray area in credit, I guess you could say, but we try to apply our policy, consistently. We rely a lot on our sales team, and they actually have the relationship with the customer, obviously. So a lot of times, if there's some questions or there's a gray area, we may reach out to the salesperson and get their insight into what they know about the customer, their operations, things like that. But consistency is important. You start, there are exceptions, obviously, but consistency, to have your credit policy established, and it's there for a reason, and you need to be utilizing it.
Gentlemen, maybe to keep help move the conversation in the direction with our listeners, if you can see the Q&A, if not, I can read the questions, but there are two questions in the Q&A that maybe are very pertinent to what you are discussing at this point in our conversation. Do you see those?
Yep, I do.
Okay.
So first question, is your credit policy the legal charge account agreement disclosure notice that your members sign, or is it an internal document that explains how FS generally enforces its credit? Actually, we have both of those documents. We have an overarching internal credit policy, which outlines what our risk profile looks like and what our risk tolerance is. And then we have our credit policy that's attached to our credit application that customers sign and acknowledge. That is the disclosures about, the legal aspects of things, what we can charge from a finance charge perspective, how everything along that line goes. So it's both. Next question, do you require a new credit application every time a customer requests a credit limit increase, or do you have a window of time that you allow historical applications to be used? Typically, our credit policy states that from a credit increase perspective, if we've got a credit application that's less than 2 years old, we can use the same one. If it's outside of 2 years, we will request a new one just to get a new look at that customer and see what's changed. That also goes for customers that are inactive for a period of 2 years with us. If they haven't bought anything for 2 years from us and had anything on their account, we can and usually do request a new credit application just to get a new look at that person, because, like I said, things change.
I guess a couple of follow-up items on both those questions, Scott, and I guess Connor, this also is relevant for CoBank itself too. But when I think about the insurance business, and I mean, they usually are out underwriting properties, re-inspecting properties every, call it 3 to 5 years, whatever it is. Probably a little more frequently now in recent years than prior, but either way, trying to keep up on their underwriting. One of the challenges that we often see in a lot of our cooperative clients is, they'll go through the underwriting process, get a signed credit application, everything's on the up and up to start off with. There's a credit limit assigned in the system. However, usually that credit limit in the system doesn't necessarily talk to what's actually charged to AR. So usually what's charged on their account may be vastly over what that authorized limit is. And there seems to be some challenges around monitoring that, seeing if they're over, and if they are over, Does their credit limit need to be increased? And if so, what needs to be done there? But I guess also tagging on to that is, how often do you see others, whether that's, CoBank or Scott, you at Insight, or some of your colleagues, how often do you kind of re-go through and underwrite your credit to see, okay, this person was authorized for $100,000 of credit in 2014, it's 10 years later. Should they still have access to $100,000? Maybe that's because one, commodity prices have changed a heck of a lot, but two, maybe their financial picture has changed a lot. So a lot there, but basically, yeah, systems asking, how often do you monitor authorized limits versus actual spend on account? And then two, how often, do you guys see in your own businesses that you go through and reevaluate credit standards?
You want me to take that one, or you want to?
Seems like that's more of a practitioner.
So couple things in there. How do we monitor when customers go over their limit? Our system will provide a pop-up to whoever's processing that sale that will let them know, hey, you're going over that credit limit. Do you want to proceed or not? Typically, that should be the key for that individual, to check with credit to make sure that's still allowable. We tend to utilize that somewhat, not as much as probably we should, honestly, because it doesn't stop the employee from moving forward with that. But we do get notification when they do go over, assuming that it's somebody that is has a good history with us, has a good payment history with us. We'll allow that to go through. We do have some checks and balances though on customers, and we do get some of our location admins that'll reach out to us and say, hey, I've got this customer here. He's wanting to do this. Are we okay with that or not? And we can kind of take a quick look and see where we are with that. And after knowing the customer base, we can kind of get a good feel for where we are with that person and if we want to continue or if we want to make sure that customer pays before they leave, so to speak. Sorry, what was the other part of that question there, Mark?
Well, it was kind of, it was twofold. Yeah, I was monitoring the limits, but also how often do you go back through and re-underwrite credit?
So that we're working on a process right now for that, where we're going to start looking at customers on an annual basis, going forward. We're looking at implementing a new system here in the next, I don't know, 6 to 12 months that'll help us with that process. So that's something that we're kind of developing because we know that's a weakness on our side today, and that's something that we need to really kind of shore up.
With just the vast number of patron members that a lot of our co-ops have, I have to believe that's a challenge at a lot of different places, not just Insight FS.
Yeah.
I guess Wendy's got a pretty good one in the Q&A, Scott, if you haven't seen it yet. Once again, I'm going to use Connor's line. Seems like a practitioner question.
With where crop prices are today, when a customer applies for a loan increase or a new loan, how do you evaluate loan to crop value parameters? So when with crop prices and customers come to us, from an additional increase on their line, we look at a couple different things. We look at, what the circumstance is. Why are they asking for more? Did they pick up more acres? Did something change? Their crop mix change? What happened in there that they're asking for this increase? We'll also reach out to the salesperson. Okay, what's going on? Why are we doing this? Is it a second pass of chemicals? Did something happen with the first one? Is there a lot of weed pressure we need to do more with? What's going on there? And then we'll get an overview of their overall crop mix, how many acres they're doing of whatever they're growing, and get some average yield data, and just kind of sitting down and determine what what their cash flow is going to look like at a high level and see if, okay, is this going to make this too risky at that point for that increase? Are they going to be able to cash flow at that level? What's it look like? Where are we in the pecking order in terms of, is there somebody that's got a lean out ahead of us, or where we stand in the pecking order of getting paid? We run into a lot of situations where we've got some bank financing and our own financing, and we may be in a second or third position sometimes. So we've got to evaluate that as well. See is there enough cash flow to cover everybody that's in front of us as well.
Speaking,
Go ahead.
well, I was thinking, speaking about the topic of kind of reevaluating or evaluating, and this might be more of a size and scale question, but how often, Scott, is maybe the leadership at your organization or kind of reviewing the internal and external credit policies? Is it an annual basis? Is it semi-annual? I would imagine you're actively engaging with outside legal counsel. How are you guys dynamically changing with maybe a commodity run or just the general ebbs and flows of the farm economy and economy to make sure that the application still is resonating and that the policy is proactively adapting?
Sure. Yeah. No. We kind of take a look at the general farm economy actually, and what's going on. We've got a legal counsel that we work with, to your point, that helps us with our credit policy. As things change, we will kind of update that policy depending on changes in laws. Not so much. I think our policy is pretty conservative from a standpoint of the farm economy. So primarily we're reviewing for legal updates, things of that nature. But as far as our review internally, we actually do something here that's probably somewhat unique to other cooperatives, but we actually require all of our salespeople to review our credit policy and acknowledge our credit policy on an annual basis. So anybody that's in a customer-facing sales role is required to read it, sign a document, say they understand it and are acknowledging it, and we actually hold them accountable for that AR that they put on the books. We have some information around cash on delivery accounts and how we handle those versus charge accounts, and those salespeople are actually incentivized based upon our AR. So they've actually got some skin in the game there. So we review that with them annually, and then as we go throughout the year, we're constantly reviewing and updating for any legal issues or changes that we see.
Seems in the past, when we've gotten into these periods of really tight margins, the key thing is communication. So you've talked about your communication, your expectation within Insight with your sales team. How do you communicate that with your customer base, which is so diverse? Because you're also extending product and services to non-farm population as well. So there's a wide base of products and services going out under credit policies, but a very different consumer of those. So how do you wrap all that up?
So yeah, we as far as internal communication, I'll start there with internal communication with our sales teams, and that we have monthly credit meetings with all of our sales team to go over our past due accounts, and we have some very open communication about how we want to handle that account. A lot of times the salespeople will want to be involved because they own the relationship. They don't want to lose that relationship with the customer, right? So if we'll bring this up to them, A lot of times they'll say, "Hey, let me reach out to that customer. I've got a good relationship with them. I can talk to them." There's a stigma there that credit, if we get involved too much, we're gonna ruin the relationship and ruin any potential sales. And that couldn't be farther from the truth. At least in our shop, we handle everything very much with a customer centric um, kind of attitude about it. We want to preserve the relationship. We want to keep these customers. That's how, we make money, right? And we make sales. So uh, going in and destroying those relationships would not be beneficial to anybody. So we try to really go and take a customer centric approach to that, involve the salespeople. Um, we have a series of letters that we can send out to customers as they start going further and further past due. It starts off with a very uh, polite reminder type of tone. Hey, just a friendly reminder, you have this balance out here. Please take care of it. And we can escalate that if we need to. And if the customer doesn't respond to that, we also try to make phone calls to customers because sometimes, letters don't necessarily get read, right? So we can make phone calls to customers. If we've got approval from customers from previous conversations to text them, we'll try texting. We'll try pretty much any kind of communication that we can with our customer base to try to help them uh, clear up whatever their situation is. And of course, that sometimes can be difficult because the recipient, the customer itself, sometimes gets into a situation where they don't know what to do, and they panic, and they just shut down on us, and they don't communicate with us. And I've told my team, I've told our sales staff that the shutting down of communication is worse than telling us they don't know what to do or they can't do anything. If they talk to us, we're more than willing to work out whatever plan that could be reasonable for both parties, again, to save that relationship. We're here to collect our money, obviously, and to make the sale, but if we didn't have our customer base, we wouldn't be here to serve customers going forward. So communication is very important from that standpoint.
Hey, Scott, I got a question.
Sure.
When I think about, the success of a credit policy, I think it may come down to culture, right? And
Hmm.
kind of setting the tone from the top. But
Yep.
I also think, I might have clients on this call here and they might push back, but I think, credit policy can almost embolden your salespeople to a certain degree because it gives them kind of, institutional support when they hit
Yep.
the countryside. So I want to have you maybe talk about, how important that is and setting the culture from the top. I got a text informally here, not through the Q&A, that was described an experience where they've been lax on a credit policy, and they're trying to implement a new policy kind of overnight, and they're worried about that rollout and how that process will be. So if you could just kind of talk generally about the importance of culture and why a credit policy can actually embolden your staff rather than create problems down the line.
Oh yeah, absolutely. Yeah. It is definitely a culture thing. There has to be buy-in at every level. We've been lucky enough to have some very good leadership here in the past 10, 15 years that have really been very supportive of credit, understands how credit plays a huge role in the overall success of the cooperative. So with it starts there, and as we get buy-in from the various levels, everybody understands why credit is important. A lot of times credit's called we joke around here that credit is business prevention. But it's further from the truth than that. Actually, it's helping set those guidelines to say, you know, we can't take all customers, but here's the customers that we're looking for. And it helps, to your point, gives the sales team a better idea of what we're looking for, quality wise. We don't want to just pick anybody off the street. We want to pick the right customers. So culture is very important, and I think that's gone a long ways. To your point, um, you know, over the years, showing that support from leadership saying, hey, credit is important. We've got to do these things. We've got to, establish what that policy looks like. We've got to really make sure that people are following through and holding those salespeople accountable to their sales and to the customers that they're dealing with. And that's been huge over the years. It does take a while. It takes a while to get it to filter through to everybody because there's, over the years people can build up, you know, uh, a lot of bad habits and things, and so to break that down and to get people on the right track and understanding the direction we're going, it can take a while.
Yeah, I guess one of the things I'd like to talk about a little bit is a question that's almost impossible to answer, at least on a general basis. Um, Kind of going back to one of Dan's comments earlier, and then also kind of I think it'll lead right into the first comment we have, or question we have in the Q&A regarding, do you require all customers to sign a security agreement with their application? With some of the decrease in commodity prices, whether we're talking about milk or the price of corn and beans and wheat right now, and on-farm income being lower in general, at what point in time, how does your organization, Scott, or others that you work with, what's your experience of how you guys make that decision of when to go on to basically cash, or when you cut someone off altogether? Because the thing that I hear from a lot of clients, um, and also kind of piggybacking off your comment earlier, one thing I hear often is, if you work with us, we'll work with you. Going back
Mm-hmm.
to your comment earlier, which I think is a difference from doing business as a co-op versus doing business as a private entity. But making that decision of when to shift someone to cash or just cut them off altogether, um, seems to be one of the hardest ones to make, just because obviously you're affecting the livelihood of someone's operation. And there's that delicate balance of, well, I need to feed the cows to get the milk to get us paid, but how does that balance look, and how often are you guys working with them? And like I said, we always hear, well, they're good for it. They've always been good for it. Well, we've worked with them forever. They've got a lot of acres. And also going back to the other point, a lot of times those other acres are spoken for by a lot of other creditors. So
Mm-hmm.
a lot
Mm-hmm.
there, an impossible question to answer. So I just thought I'd ask.
Yeah, no, it's that is a great question, and I don't know what the right answer is, because there is no hard and fast line in the sand. We can put in our credit policy all we want, anybody over 90 days past dues on cash. Do we follow that to the letter of the law? No. It's that's where that gray area comes in, because there's so many things that could be going on with that customer. And if you put a 90 days in your credit policy, you know, can you not put somebody on cash at 60 days? It kind of depends on the scenario. The big thing is, is the customer actively working with you to try to resolve the issue, or are they just trying to dodge the issue and buy time? And that's kind of a feel situation that my team has as they're working with these customers. They've kind of got enough latitude to be able to say, okay, this customer, I feel like this customer's trying to make progress with me. We're working with them. We're putting a plan together. We'll go ahead and let them charge. But then there's other times when the customer is like, you know, not necessarily, being forthcoming with everything, and not being an even partner in this to try to figure out a way to do this. And at that time, we'll have to maybe take a hard line and say, hey, it's time that we cut them off until something happens. It's there is no right or wrong answer on that. It's kind of goes by feel. But I know one of the questions and what you'd asked about, when do you bring security involved? And I guess you know we look at a lot of different options to try to get customers back on the right track, right? We try to work with them, give them every opportunity to follow through on what they promise. You know, if we can get them to establish a payment um, program with us to say, hey, I can pay you X amount of dollars over this period of time, whether it's weekly, monthly, whatever, and that's something that we feel we can live with and the customer can live with, and we give them a shot, we'll try that without having to take any additional security or collateral there. Um, but if they slip up and they don't follow through, then we have to have that follow-up conversation. Say, okay, what happened? Why didn't you make this payment here? Do we need to get on something a little more structured? You know, depending on the type of customer, is that a milk assignment? Is that a monthly, weekly ACH program? You know, we have a lot of our feed customers are on weekly ACHs where we just get the money straight from their account automatically, and that really helps from a risk mitigation standpoint. Feed can build up very, very fast. If somebody misses a payment, you wait a month and they can't make that payment, well, now you're 20, 30, 40 plus grand, you know, behind, and those holes can be pretty tough to dig out of. So we try to make it as flexible a terms as possible for customers, whether that be weekly payments, or what have you, to get, you know, back on track. But we will, you know, in times we have said, okay, well, you know, maybe we need to take a milk assignment here to get you cleaned up. Maybe we, you know, hey, for every delivery you pay, you know, $1,000 over what you purchase from us, just to make it smaller chunks to whittle it down. You know, there's lots of different options there, and we try to be creative and flexible enough to give customers the way to help themselves get out.
That last comment you made is a pretty common one that I see, at least in my client base, where, you know, we're going to keep extending you credit or at least keep delivering you products, whether it be feed, ground meal, whatever it is. But in return for that, you're going to have to pay a little more than that bill for that month.
Mm-hmm.
And maybe there's something that's done finance charges, maybe not. That's kind of a case by case basis by cooperative. You obviously, if you have finance charges in there for a reason, and maybe you're in the 0% borrowing environment or close to, that wasn't as big of a deal. But I mean, in general, at least in the clients that I serve, we're seeing pretty much across the scale a shift from, you know, current to 31 to 60. We haven't seen a big chunk of our clients, page members, go from that 31 to 60 if they were there before to the, you know, the 90 plus. But we are seeing probably at least I'll call it 5 to 10% of that AR shift from current, that 31 to 60 day bucket, which once again with current interest rates, which I think Connor's the one who sets those and charges them to customers. Um, he's the reason some people's P&Ls look so bad, I think. But that has, I mean, it can have a significant impact, obviously, not only your cash flow, but also your bottom line if you become the bank and financing institution for a lot of your members.
Right. Yeah. And I know, Mark, we talked about this at one point in time that uh, one of the things we will do also when we negotiate with our customers, we can negotiate on some finance charges, and if you know, as opposed to turning off finance charges or lowering finance charges, I'd rather forgive some after the fact once that customer uh, completes their part of the deal, as opposed to cutting the finance charge in half or negotiating the finance charge, because to your point, then we become another source of finance for them, and they'll pay other people first if our rate is cheaper than other people's. We do some negotiating, but again, it's more on the backside after the finance charge has been charged to say, okay, hey, I can cut you a little bit of a deal if you can do this. And once that's done, we'll write those off. So that's kind of how we keep trying to keep people moving towards getting us paid first.
Hey, Scott, one quick question just to make sure I want to
Sure.
answer one of the Q&As was, is it standard operating procedure for your organization to automatically file a lien or a security agreement? Or is it a case by case and, you know, size? But what I'm getting from your, you know, body language is it might be case by case.
It's case by case. It's definitely not every, and by far, our open accounts, we don't have much in the way of security on those. We do have other programs. We've got a financing program for agronomy customers, specifically for um, uh, that we do take security on that in the form of a UCC filing, but that's more of a longer term cash flow thing than a monthly open account. On our monthly open accounts, I'd say we have very, very few people that we have a filed a lien against. Those are on a case by case and pretty extreme situations.
And then is it more common than not on, let's say it's dairy, swine, poultry, feed customers to have them on automatic ACHs either weekly, bi-weekly, or is it also a case by case?
It's kind of, well, we kind of actually incentivize them by giving them a small discount if they would sign up for that weekly ACH, which then obviously helps entice people to do that. But again, we don't require it on all customers. It's kind of up to the customer's choice to how they want to pay their bills. Um, in a few situations, we'll say, nope, I think you need to be here to do business with us. We need this. But again, that's on a very minimal basis. We try to provide enough ways for customers to pay us that it makes it easy for them to choose. You can stop and pay at a location, you can pay online, we can automatically draft it. And the easier I think we make it for our customers, the more likely they are to pay us.
Thank you.
Yep.
Mark, you work with co-ops basically coast to coast. Do you see regional differences in how co-ops handle this based on the type of agriculture in that area? I'm just wondering what you see from an auditor's perspective.
Yeah, we see quite a few differences, Dan, across the country. I would say, predominantly in the Midwest, the heavy dairy production state we're in, obviously, but also like in Colorado, California, Texas, there's a lot more dairy exposure. And so with that, I think people are a little more, their AR is a little more, I guess, volatile. Um, but there's also at those organizations, to Scott's earlier point, uh, feed accounts in particular have a way of creeping up real quick. And they've always been good, and they've always been, covered their bill. And well, yeah, milk's just a little tight right now. Their contracting was pretty poor for this period. They didn't contract at all, whatever the case may be. And all of a sudden they're 3 months out and they've got an account that's, $500,000 past due. Um, so we've seen a lot of clients really trying to push ACHs in the last couple of years. One of my follow-up questions to Scott was going to be, one was how you guys incentivize customers to switch to ACH. Obviously, it's a convenience to them, but some people still like to control, obviously, what's going in and out of their own checkbooks. It sounds like Inside FS offers a little bit of a discount for that. But I have to believe that's still a challenge, and I shouldn't say I have to believe. I know it's still a challenge for a lot of our clients getting customers to enroll in ACHs. But that's one of the key changes we see across, I guess, the country, Dan. One of the other items is, we've talked a lot about being underwriting heavily and red flags, but we also see in pockets of the U.S. where people, in my opinion, underwrite maybe too tightly and don't extend enough credit, where maybe they're missing opportunities for sales. We see that a lot more, quite honestly, it seems like out east, where there's very little credit that's extended in those organizations. And if they do any sort of financing, almost exclusively through, whether it's through John Deere financing or CFA, some sort of recourse or non-co-op type financing program, we're seeing them shift that risk to other organizations, which once again is a risk management decision for the board and governance group, but you also end up losing on some margin. Right. I guess counter that, there's a co-op we work with out west where they do almost exclusively everything is in-house as far as financing goes with their own financing programs. And we see some of that in the Midwest here as well. But their thought is, over time, especially with where some of these rates are at, why would I give that margin to to another lending institution when we think we have the underwriting in place to make sound loans? And if we get burned by a few, that's just part of business. But overall, we're going to have much higher margins financing ourselves versus pushing that to another organization.
I want to keep current with the chat, and I know there's 3 questions in there, so in the Q&A, so maybe we should try to address those. I think their first 2 at least are directed at you, Scott.
What are some of the software changes to online systems that you've utilized to help make customer communications improvements? So we try to do a lot of electronic communications, whether that be through emails or online presence. I know that we do a lot of I think Constant Contact is who we use for emails. And that's been a challenge too in itself, getting those emails. And it's been a little bit easier since we started having our credit applications all be online and through DocuSign, because you need to have an email address. So the email address is provided. So I'd say in the past 9 months or so, we've been really able to ramp that up and get a lot more email addresses and things to be able to communicate with people that way. That it's a tough one because everybody has a different way they prefer to be communicated with, and trying to hit all of those and be cognizant of the expense of that communication. There's a balance there. So next question here. What level of visibility, if any, does your board have into particular customer credit limits and credit exposure? So at our board meetings, credit gets to be one of the topics that's discussed at every board meeting. So lucky us, but we don't necessarily go through board level limits, credit limits. We go through more of here's what our AR looks like. These customers over 90 days past due, we go through each one individual account down to $1,000. Basically, we list every of those customers out and go through what their plan is, or what we're doing with that customer to get them back into good standing and off that list. So that takes place monthly. We also go through our finance portfolio that's separate from our open accounts. Go through volumes, where people are. We do have a recourse program, so we look at our full recourse accounts, the accounts that are more risky to us, and we list out who's where. And typically, if they're on that list, we've typically got some security there in the terms of joint checks, milk assignments, or what have you, to get that resolved to try to mitigate our risk. So that's all done on a monthly basis, and we go through quite extensively.
Scott, do you report to like a finance committee of the board, or the full board?
The full board.
Full board.
And I think the answer is yes, based on your response, Scott. But do you guys list out actually member names?
Yes.
Or just member? Okay.
Yep.
That's one thing we see. Varies co-op to co-op. We see some that show all the detail, and others just basically show account numbers or some non easily identifiable characteristic. That way, it limits the possibility for things maybe to leave the boardroom that should stay in the boardroom. I'll put it that way.
Mark, I think one comment that I would make on that is, if the board can't be trusted to hear accounts receivable names, there's questions on greater transparency at the board level, right? And so that'd be one comment I would make to that, right? Where the management should feel confident that their board can keep the names of aged receivables
Yeah, I believe
confidential.
that's been our I believe our thought process is that we ought to be able to support, we should be able to trust the board not to walk out and start spreading that information out in the country. So,
I would agree with that. I think the counter thought from some other managers and credit managers out there is if we don't put that board in that position to begin with, it won't happen. So I understand both sides of it, I suppose. And then there's Wendy's got another question as far as Scott, more pointed towards you as far as earning patronage or equity, patronage, I guess, on their financing.
so so we used to have a program, call it a rewards program, wasn't really a patronage program, um, that we had specific to our lending portfolio. Um, that we've discontinued a couple years ago, and we're looking at trying to bring something to the table. But from a patronage perspective, no, that the loan itself doesn't tie into that patronage calculation. Obviously, purchases, how much they purchase with us does. So we can say that our loan program creates the ability for customers to maybe purchase more with us than they would have without the loan, which would therefore increase their patronage, but nothing specific to the loan itself.
So that's pretty consistent with what I've seen too. I mean, I would say most of our clients, if they do have a financing arm in their organization, that's usually non-patronage sourced income, I guess, for the co-op. Unlike obviously if, Insight does business with like CoBank, or any other farm credit type system, obviously you're going to get patronage back on that financing.
Mhm.
Speaking about patronage, one topic we haven't covered is how Insight might handle equity to cure delinquent accounts, maybe writing off old equity. What, what's your company's perspective on that? And then Mark, what are you seeing and advising your customers?
So we don't use equity per se to pay down or offset uh, any of our outstanding um, accounts until we get to the write-off stage. At the write-off stage, we will look to see whatever stock the customer may have with us, and we'll use that to offset the write-off. But we don't use that in any of our open account conversations with lowering their balance that way.
So it's a last resort. We're not going to do business with this customer again. Let's or at least for the foreseeable future, let's deduct the equity because we're not going to get anything anyways.
Correct. Correct.
Okay.
Yeah, Connor, I guess to answer the side that's more relevant to me, um, one, having that right of offset in your bylaws, which I think is for the most part pretty common. I mean, that's absolutely necessary in my personal opinion. So you have the right to do that. In addition to that, it's also really nice to see in our cooperatives bylaws that they have the right to apply a reasonable discount or something similar to that. So you think about that equity that customer may have built up with the co-op over a number of years. Maybe the co-op's on a 10-year involvement, maybe it's 15, maybe they retire equity by age or estate even. And so there might be a significant timing difference of when the co-op is offsetting that equity against that patron member's account. And to me, there should be a in my opinion, what we're advising our clients when possible in accordance with their bylaws, Connor, is are they considering basically their own return on assets in their organization and discounting for that time value of money? Because I mean, they're giving up, and then at the end of the day, they're giving up dollars today that they may not have paid out to that member in, you know, 15 or 25, 35 years. Just throwing some numbers out there. So, um, discounting and considering your return on assets or what that opportunity cost, I think is a pretty important thing to do. But what do I see most often? People just applying the equity at face value. If that's what happens, I think most often in the wild, we'd like to see a little more discounting happen. but that's just from a cold-hearted auditor standpoint.
Looks like, Mark, in the Q&A, you've got a question from a tax perspective if you want to take a look at it.
As a non-tax professional, I will do my best. How do you look at prepaid in previous years for next year's product but not paid in cash? A loan that's not due until next year. Yeah. So what Wendy's more or less describing, I'll try to reiterate the question, is there's kind of I'll call it the farmer prepaid tax planning program, where they might prepay for a product in a prior year, and then more or less just kind of keep that rolling. From a farm side of things, one of the things that most of our co-ops, I think, more or less do, and Wendy, you can let me know if I'm not addressing your question properly, is most co-ops, what farmers do for their own tax planning, that's up to them and their tax preparer. It's not their responsibility. For a farmer to legally take a deduction for a prepay, it should be for a specific product at a specific price, ideally with a delivery within 12 months, obviously. That's what it should be. What actually happens, once again, in the wild, I think there's a lot of times that farmers prepay or just have a large credit they'll pay on their account. We see it quite a bit more actually on the feed side, where people just prepay a large dollar amount, overpay by $400,000 or $500,000 at year end, and it's not for any given product, just a large payment on account. So what the farmer does on their own personal taxes is kind of their own business, in my opinion. From the cooperative accounting and tax standpoint, a prepay is a prepay. Well, if you're on the cash basis, which I don't think any of the co-ops I work with are, it would be income. But from an accrual basis, it's not income or taxable to the co-op until it's been earned. Does that answer? I guess you're not live, Wendy, but if that doesn't answer your question, you can maybe re-throw something in the chat.
So, Connor and Mark, when you're working with various co-ops through your regions, how much do you get involved in, setting, advising your clients, your cooperatives that you're working with, on governance practices, best practices in the boardroom? I'm thinking of, a director who's on the board that might be at that 90 days out, and unpaid, those types of issues coming up. And I know, Mark, you see a lot of this through the auditing process at the end of the year, but how actively do you coach co-ops on these things?
Actively, usually we're kind of after the fact, I guess. But related party transactions, we actually just had an audit and finance committee meeting with a co-op in Colorado yesterday, and there's a lot of heightened, not just in Colorado, but in general, there's a lot of heightened, I think, maybe not risk, but attention brought to related party transactions, and making sure that credit terms are the same, whether you're a quote regular farmer member or from some sort of employee or relative of an employee. We've talked about the internal controls related to those transactions. I think, from my standpoint, Dan, that's where we see a bigger, maybe it's not a risk, but something you definitely don't want to fall into, and make sure that business is being done on a fair and equitable basis across all your farm members. And obviously fair and equitable doesn't always mean equal. There's a lot of points today Scott talked about terms being on a case-by-case basis, and I absolutely believe in that. But if someone's terms vary from another, there should be pretty good underwriting standards that support that decision. And to me, I guess the way I always look at it is, if you can't stand up at your annual meeting and explain why someone has different terms than someone else, and obviously that's almost, I hope, never going to happen in real life. But if you wouldn't feel comfortable explaining the business case behind a decision, then there's a good chance it's probably not well supported. I guess is how I look at it.
If I could add maybe to that, I think setting the expectation for any oncoming board member should be upfront. That, just because you're on the board does not mean you get preferential treatment in how we go about carrying out our credit policy. And, from a, transparency and perspective, you should almost be extra judicious in how you go about handling board member business than patron, because of that perception that could occur in the countryside. But this can all be kind of talked about up front when you join the board of directors, saying, this is a board of director policy, and these are our expectations we have for you for joining the board, right? And so, be just like a credit policy can embolden, salesmen, it can, embolden other board of directors by having, established standards that they abide by agreeing to be on the board, which is an important responsibility.
Any other issues that you gentlemen wanted to bring to the forefront today?
There's one topic that I'd like to cover from the bank's perspective, and it's how CoBank and how I would imagine even commercial banks kind of view aged AR. So in the business there's quantity of working capital and quality of working capital, and if your business's current assets are being tied up in aged accounts receivable, that's decreasing the amount of quality working capital, I would say. And so when CoBank lends money, generally speaking, to a co-op that's on, let's say, a borrowing base, right? For those that are on the call that know what it is, it's basically how much current assets we will apply advance rates and lend up to that amount. So it's the current asset collateral that's supporting your line of credit. We deduct any accounts receivable over 90 days for the borrowing base. So if you have an accounts receivable problem, with a lot of dollars tied up in AR over 90 days, CoBank's general practice is to not consider that as collateral supporting your line of credit borrowings. And then if you take that to the next degree, let's say you've got farmer A or commercial account B that's got 100,000 in AR that's over 90 days, and you haven't moved him to cash on delivery, and you're still doing business, and he's got a bucket of 30, a bucket of 60, you take the concept, and all of that AR is considered non-supportable to support your line of credit borrowings, right? And so, that's one topic I wanted to stress here for those that may be on the call that have borrowing bases is a credit policy does impact potentially the banking relationship you have with your primary lender, whether it's somebody at CoBank, Farm Credit, or a commercial bank, because we don't consider that sound collateral if it's aged AR. And then secondarily, the banker can't leave any meeting without talking about interest rates, but carrying AR at 7, 8, 9, 10% interest is a lot different than 4 years ago when interest rates were 3 to 5% carrying that AR, right? And so if you have to take write-offs, or you apply equity, or you waive finance charges, you are accruing that interest expense potentially if you were using your line of credit to carry that receivables into the future. So that's the piece that I kind of stress with my customers is, slow collection and waiving finance charges could, impact you more than you think, because it's hurting you on the interest expense line item on the P&L. So I just wanted to provide that 2 cents commentary from the banker's perspective on, an aggressive collection policy, staying on top of things means you're converting your sales into cash much quicker and applying that cash either against the line of credit, or you're investing it in excess funds and generating a return.
What about the write-off process? Can you explain that a little bit? Maybe a lot of our listeners are more understanding of how that works than I am. You want to take that, Mark? Do you want to take that, Mark, on the write-offs?
Oh, the write-off process? Sure. Sorry, I missed that. So for the write-offs, in general, I think there's usually, I would say there's quite a bit of inconsistency in our client base from when they actually write an account off. Um, uh, I would say most of our clients, nearly all of our clients, will allow for that allowance for current expected credit losses. The new terminology used to be allowance for doubtful accounts. We have to make something exciting in the accounting world. So now we call it the current expected credit loss. So I guess if there's one plug for accounting on the call now, when you're establishing your allowance for doubtful accounts or current expected credit loss, in the past you considered what conditions were in place as of your period end and kind of historical trends analysis. And now you're also incorporating, which I think a lot of our clients did this historically anyway. You're also considering what are those economic conditions look like on a go forward basis. So if you're sitting 2 months after close and the dairy market's collapsing or the grain markets are weakening or opposite strengthening, for example, you're using that information and kind of setting your allowance. So circling back to your question, Dan, I think we have a lot more clients that'll leave balances on the books longer without writing them off just because of depending on that customer and the type. And I'm not a bankruptcy attorney, to be clear. There's my asterisk. But I believe depending on the type of potential bankruptcy that a customer would enter into, I believe whether you've charged off that balance on your financial statements or not does impact your ability to go back and try to recollect that debt from a member, or I should just say creditor, you know, someone you've lent credit to in general. So we see a little bit of a delay. Obviously, once you get to a spot where, in Scott's words earlier, you've sent those nice letters and then you followed up and you followed up again. And if someone's going into ostrich mode or just ghosting you altogether, or you've gone as long as you can and things aren't just working out, um, in all those instances, our co-op clients, they're obviously turning off, not accruing financing charges anymore. That's something obvious you can always kind of calculate off the side if need be. But I would say at least placing those accounts on non-accrual status is important, but probably most important from our perspective, and I'd imagine from Connor's perspective as well, is making sure your allowance for credit loss covers any troubled accounts. So does that answer your question, Dan, or I skirt around it well enough to?
No, that's perfect. I'm just thinking about the volatility that we're dealing with in the agricultural markets now, and then the interest rate changes as well. So, Scott, is annual review of policies and conditions enough? It seems like, with the dairy markets that we see and the commodity markets and the increase in cost, it would almost have to be a monthly reassessment of your situation, unless I'm overstating it.
Yeah, I mean, we're obviously very close with those customers as they start showing up on our aging reports. So we are constantly, I guess, evaluating the credit per se. I don't know that we're evaluating our credit policy unless we see something really, really big as an overall, kind of macroeconomic type scenario. But staying close with the customers is important. Trying to get ahead of it and then kind of after the fact, okay, why is this happening? Do we need to adjust anything in our policy, um, or do we feel like we're we're strong enough in there? We just need to execute on it.
And then we always throw in the whole weather situation, such as we saw last summer when it stayed dry for so long, or delayed planting, or any of those types of things. So I know one of the things that we talked about the other day, gentlemen, when we were planning this cause, we wanted to use a couple both positive examples of cases that you've worked with, so that we do have a positive aspect to what can be a difficult conversation, and then maybe some stories of way to avoid things. So any of you like to share first on the positive, and then maybe when things didn't work out so well?
I guess on the positive side, one of our I guess, nicest things to see, because usually it's part of the audit process. You're going through and, someone's pounding on Scott going, hey, you got these accounts for 90 days. What's going on with these? What have you collected since year end? What's your plan to collect on these in the future? Are these even collectible? And you're just grilling them and grilling them. And Scott or someone like Scott is talking about, okay, well, here's our plan. Here's what we've agreed on. Once again, going back to Scott's earlier points where you're looking at basically, okay, have we actually looked at your break even point, or what your cost per acre is, figuring out what we think your profitability is going to be on a per head or per acre basis, and actually having some sort of plan together. Maybe that even comes alongside of them as far as helping out with their marketing. How are you basically contracting and marketing your commodities? Kind of being alongside of that customer every step along the way, because if they do well, you do well, is what it comes down to. And so one, I guess, my favorite things to see without a specific example, Dan, is when we see accounts that are consistently aged and they build and build and build, and we hear folks like Scott say they're good for it. We have a plan. We have been discussing with them. Our sales team's involved, our CEO is involved, our credit manager's involved. There's a lot of people close to this thing. We're in close contact with their bank. And then to see that customer slowly start to work out of it and ultimately just come off that watch list altogether, that's that's a pretty enjoyable process for me as an auditor. I have to believe it's a whole heck of a lot more enjoyable for someone like Scott and the management team. But that's also, to me, a nice success story in the co-op community. And going back to a comment I made earlier, that's a key difference, I believe, is a cooperative. I mean, you're serving your owners are your farmer members, versus I'll use a publicly traded company, for example. You're chasing a return on investment for your stockholders. In a co-op, you're answering to a board, but you're also answering to your owner members. And so it's just a different dynamic. And I think in general, people want to see each other in the co-op space succeed, and they don't want to see their neighbor farm fail. They want to help people out. So I guess those are my favorite types of stories I see. To the flip side, what's the most disappointing, and I can just basically everything I just said, just basically reverse it and say that when we see a account that's getting aged out, and we talk to folks and they go, okay, well, yeah, no one's talked to them. We've sent them letters, but they haven't responded. And now that usually it's a feed account, now all of a sudden they're 3 months past due. Oh, well, here comes planting season. And by the way, we just also financed all of their inputs, not with any sort of financing program. It just went straight on their account, which they're already overextended on, past their authorized limit, which wasn't caught by anyone. And so now it's, well, we got to wait till they get the crop off in the fall, because then they'll be good on it. And then obviously the story there, it builds and builds and builds. There's some sort of succession, or usually a lot of this is spurred by some sort of unfortunate health event with our clients, and someone on that farm has a health issue or some other off-farm issue, and it slowly deteriorates and ultimately ends up in some sort of bankruptcy setting. And just seeing how the basic blocking and tackling of following that credit policy and the culture that Connor's talked about earlier, with salespeople being emboldened by a credit policy, by credit managers being involved, with the board of directors reviewing those troubled accounts. Usually when there's a quote disaster, the writing's been on the wall. It maybe doesn't happen right away, but usually it's people not willing to make a tough decision, to quote, in their mind, ruin a relationship, just for the sake of extending them credit and keep floating someone along. And usually you're actually hurting, in my opinion, you're hurting that client, you're hurting that farm more than you're helping them by continuing to advance credit. So those are the sad ones, I guess, is when there's plenty of opportunities along the way where you could have looked at your credit policy, you leveraged your sales folks, got other people involved. Stop if they're not answering the phone, if they're not picking up letters. Stop out the farm, talk to them. It's awfully difficult to I guess not tell someone the truth when they're sitting face to face with you, I guess.
Right. I think it's, the most important thing is to avoid that situation where the fuel tank is empty and it's or the home heating oil tank is empty and it's middle of January and everyone's in crisis mode at that time, and maybe looking back and seeing all the missed opportunities to avoid that. I think that's probably one of the core reasons why we're having this discussion. Good planning, preparation to avoid those types of things. Connor, any thoughts?
Well, usually when I get apprised of situations, it's all bad news stories, and I don't have a lot of good news stories to maybe tell. Dan, I think the the main takeaway from all the bad news stories typically is we just thought, right, or they've been doing business this way for a decade.
Mm-hmm.
And then, the other piece is I've always kind of stressed is, why is the customer leaning on the co-op at a finance charge rate rather than working with a local bank or, Insight or CFA, or one of those products, and why are they leaning so much on the co-op at that finance charge rate? That's always my 2 cents. Unfortunately, I don't have a lot of good stories because the banker only really asks when things go wrong.
Scott?
So yeah, I mean, kind of, copy what these guys said. Good stories are always ones, that, to Mark's point, people have gotten into a bad situation and we've been able to help them work it out, and have been able to communicate both ways. We have a saying, bad things happen to good people. That doesn't make them bad people. It just means that they need help, and how can we help them? And so, getting back to the communication is key. Hopefully there's reciprocated communication, and they don't just, put their head in the sand and hope it goes away. But, all the good stories we've had are working with customers, trying to do what's in their best interest and what's in our best interest, and not having to, get to a point where we have to say, we got to cut you off. And, because if that happens, that's just, the relationship's going to be scarred, and your likelihood of getting paid goes down. There's got to be a point though where that happens. And on the flip side, bad stories is, unfortunately that happens too. And it seems like it happens from a lack of communication both ways. I think, Connor, you said it, that you think, we thought this was going to happen. This customer has always, come through in the past, but nobody reached out, nobody communicated, nobody closed that loop to make sure that this wasn't something else than what has happened in the past. You can't assume that just because somebody has done this for years and years and years, and all of a sudden it happens again. How do you know it's not a health issue? It's not something that somebody needs to step in and bring some some plans to the table, or just some open and communication to make sure that you can help them out. So
Well, I think, our conversation today was really focused on what due diligence needs to be performed, how to build the best credit policies, update those with the changing times, and agriculture is constantly changing, and then to communicate that throughout, and then of course the proper governance to support that through underwriting and if necessary, legal means as well. So I don't believe we have any other questions. I'll give any of you a chance to add anything that you've forgotten and or haven't had a chance to speak on yet. And if we've covered everything, then we'll conclude our conversation for today. Anything, gentlemen?
Nothing on my end. We've covered pretty wide gamut.
Yeah.
yep,
Thank you so much for bringing your experience and your expertise today. It was really a fascinating discussion. We had a great turnout for this webinar, and I know people really appreciated your taking the time to share your expertise. So thank you so much. And thank you to our sponsors as well, and all of you who joined us today. Is a very insightful conversation. Please please join us for our next webinar on May 30th, when we will discuss employee benefit programs for cooperatives. I'm going to check one more time. We do have one question, so don't leave me yet. It is very interesting, the correlation you raised between health issues and financial struggles. Do any of you collaborate with healthcare providers or have a more holistic ways of offering support to the co-op members you serve? Very interesting conversation. Our question.
So that question raises a very good point that I haven't taken into account. But no, the quick answer, no, nothing with a healthcare provider per se. But when those health issues come up, we definitely try to want to reach out to, family member or anybody else that they are okay with us talking to. Obviously they have to be okay with us talking to these people, and bringing in other members of the family or the business or somebody that might be able to help out. So, but nothing with a healthcare provider per se.
I would just mention that, just based on my prior experience, at the Wisconsin Department of Agriculture and the Minnesota Department of Agriculture both have excellent farmer assistance programs. The one at the Wisconsin Department of Agriculture, the Wisconsin Farm Center, which I worked for quite a few years, it's often seen as a crisis hotline. And I know Minnesota has a very similar program, but not necessarily so. I think crises arise over time when too many red flags are ignored. So as farmers work through these things, whether it be a mental health issue, physical health issue, weather, or financial concerns, there is free, confidential expert help available through your state Department of Agriculture in Wisconsin and Minnesota, and they would be great ones to work out to. So maybe might be an idea that we could share with our cooperatives, that in their newsletter or something, that we put that 1-800 number in there, that it isn't the responsibility of the individual salesperson to suggest, well, you need to go talk to a crisis manager, but we'll try to spread that word out there to the countryside more. There is really excellent help available, and that farmers, when they get into these situations, need to avail themselves of it. So, excellent question. We have another question. I guess I'm not going to be able to let you guys go quite in. Yeah, that was Wendy said, Farm Bureau and DATCAP have programs, and Minnesota has one that is modeled after the farm center at the Department of Agriculture here. So thank you, gentlemen. I appreciate your time. Thank you, everyone. We'll see you 30th for our next webinar. Take care and have a great day.
Thank you.